Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and it's December the 1st, 2014. So we're down to the last month of the year. And I just wanted to update clients on some of the key issues that have been in the market over the last sort of 6 to 8 weeks. Number one, in terms of November, the overall performance across most of the North American equity markets were pretty good. You're talking 1 to 2%, and we also across our client assets saw on average about 2% increase in November, so that's very good and we're pleased with that. Second, the US dollar does continue to be quite strong, and we've talked about this before, and the US dollar is up approximately 10% when you compare it to the other major global currencies around the world, in particular, again, currencies like the euro, for example. And this does put downward pressure, if you will, on commodities, and so that does put some pressure on markets like Canada that have a lot of commodity businesses, Australia and other markets like that. So the US dollar has been unusually strong, and largely that's because the rest of the global currencies have been very weak and are less attractive. Third, interest rates continue to trend down. And so in the month of November, we saw the 10-year interest rate that would be earned on the various governments around the world, in most cases, actually drop. So the 10-year interest rate on U.S. Treasuries, that would be the key piece of paper that the U.S. government would issue, dropped to 2.18%. 2.18%. Unbelievable. In Canada, our 10-year paper issued by our federal government is actually 1.85% annual interest rate, which is below the US. In Germany, the 10-year interest rate on the German Bund is actually 0.7% a year, or 70 basis points a year, and that's again at a record low. Even in countries like Italy, we see 2.02% on their 10-year paper, and in Spain, which again is another very weak country, their 10-year paper is 1.88%. The question you have to continue to ask, what is going on in the world? And the issue at hand really is the pressure for deflation, for prices to actually come down. This is the big concern, sort of a Japanization, if you will. The situation that's existed in Japan over the last 20 plus years hits Europe, hits North America. And so this is a concern when it comes to investing. People say, well, I see prices going up, and yes, a lot of the key items we see prices continue to go up, but the concern is overall that we could see less inflation and we could all of a sudden see prices drop. Why would prices drop? I'll just give you 4 quick reasons why. We've talked a little bit about this in the past, but this is what puts downward pressure on prices. Number one, debt. If you have too much debt, in other words, you've overspent, you've spent into the future, then as you start to pull back and people can't take on more debt, then prices tend to come down. And this is what's happened in Japan. We're seeing this in Europe right now. And eventually that pressure, of course, will be also in North America. Second, we have aging demographics. It's interesting to point out that on December 31st, 2014, so in 30 days, the youngest baby boomer will be 50 years of age. And so what we see here is this large cohort, this very large and influential group of individuals that were born after World War II are now quite a bit older. In fact, they're approaching the years of less spending, deleveraging, taking down debt, and more concerned about pensions and retirement. And that really dampens their impact in terms of economic growth and growth in the economy because they're not spending as much. Overall, growth around the world is very, very low. In Japan, it's shrinking. China is really coming off of its growth rate, so its rate of growth is decreasing. The United States has seen some growth, but not as much as it should, given the size of the economy and also the growth in population. And then Europe is seeing virtually no growth. And so when you don't have growth, you don't have pressures for prices to go up, then this ultimately puts more downward pressure on prices. And then the fourth issue is the governments are just way, way too large throughout the Western world. And so they've made these massive promises that they can't keep. And so they're caught between deficits or increasing taxes, and either one is not a good option, and it certainly doesn't lead to long-term prosperity. So those are some of the reasons. Now, that feeds into the big issue that's taken place the last 3 months, and that's the sell-off in oil. The oil price has just plummeted. Over the last month, oil has dropped on a per barrel basis, and I'm using the West Texas Intermediate, about 15% in the last month, 30% in the last 3 months, and about 30% in the last sort of year to date, if you will. So what's going on with oil? Well, there's a couple of factors. One of them is a soft economy. So, you know, we've raised our oil production to 92 million barrels a day, and there's a lot of countries that are dependent on kicking a lot of oil into the system and getting $100 plus a barrel. And so the growth in oil production has continued unabated the last number of years, and in particular the U.S. has become a large producer of oil. The demand for oil is about 1 million to 2 million barrels a day less than production. So we're getting a surplus, and we're getting a glut of oil in the marketplace. And last week, the Saudis decided to not cut production. And this is very interesting. So we're watching this because of some of the exposure we have in the industry, which I'll come back to in a second. But currently the OPEC countries control about 18 to 20 million barrels of production per day. And so the thought process was they might cut back their production to keep the prices high. Well, turns out that what is concerning to the OPEC countries is they do not want to lose market share. And they don't want to lose market share to the United States and other countries that are increasing their production. So they want to put pressure on the high-cost producers, and they want to make sure that they don't give up any of their opportunity to sell into the marketplace. So it's getting a bit of a pricing war here. And so if you're in oil stocks, you want to be very careful of the kind of oil stocks that you own, companies that can weather this type of pricing competition, because we don't know how long it'll last, and probably we should expect it to last 6 months, maybe even 18 months in order to shake out the weak players and to reestablish a price that will be more in keeping with what a lot of these countries would like to see in order to continue to fund their government. So what do we have in this sector? Well, across our ROCKLINC accounts, we have about 6% of assets in oil and gas. And I want to focus here more on the oil industry, because the natural gas market is somewhat distinct and different, and it's already very cheaply priced. And the companies that we have operating in that space, we just have 2 small companies, are very profitable and can make money at very low prices, and so we're well protected. But when it comes to the oil industry, we've opted to invest in a handful, and this will vary across client accounts, but our largest holding would be Suncor, Canadian Natural Resources, Exxon, and BP. And in each of these cases, especially in the case of Suncor, Exxon, BP, these are very large vertically integrated companies. They make money not just in the producing of oil and selling it, but in the refinery, also retail distribution, and they are generally quite low-cost producers with very strong balance sheets. So they can survive tough market conditions. And in fact, in many cases, we would expect them, if the market conditions got really bad, to be able to buy up assets and buy up reserves of a lot of the weaker companies, a lot of the operating companies that are going to potentially get eviscerated in this marketplace. So we have been very careful and selective in the companies that we own, companies that have very good dividend policies but not too high dividends so that they have to cut those dividends. and they know how to run their businesses. They've been through the ups and downs of the oil industry before. And so we want to maintain our positions, and when we feel comfortable and if prices drop enough, we can actually add to positions and take advantage of the weakness in the marketplace. And so this in our view, is a great opportunity to make some money over the next number of years. So that's in a nutshell a little bit what's happening in the market. We're seeing also, just a quick note on the gold and silver markets, which have also been very volatile this year. We're seeing a significant uptake today, and that's largely because of physical shortages. So as we've said to you before, we have some exposure, it's not large in this space, because it's a hedge against global stupidity and also government stupidity, which we see in spades. And this sector we think is grossly undervalued, and the companies that we own in it also we think have very, very significant capital growth opportunities. So we maintain that we're very well positioned. We are looking at the market opportunistically, and therefore we think that all of these things that are happening right now should work to our favor over time and provide even greater opportunities for capital growth in the days ahead. So thank you very much for listening. Trust that's been helpful. If you have any questions, please don't hesitate to call, email, or stop by the office. Thank you very much. Bye now.